if you have to understand Indian markets, you have to understand this and the hypothesis whether financialization is behind or ahead of us. So if you look at, if I draw up a context, we're looking at 826 trillion rupees, which are there in household savings, out of which 50% is financial assets, 50% in India is physical assets because of the love for physical assets. But if you look at the total equity exposure, is only 6.7% of Indian household savings. That used to be about 3.7% about 7-8 years back. Now it is 6.7, and largely due to mark to market. So if India has to allocate money into equity, 20-25% of household savings, like other countries who have gone through this inflection point, then I think there's a lot of money to come. Secondly, I personally think India has been funded, the fiscal deficit of India, unfortunately, has been funded by the Indian household for long periods of time. And banks' net interest margins in India are they're the highest in the world, one of the highest. And Indians have been designed to think that debt is the way in a high inflationary economy. I think that is changing with the new generation. So this paradigm shift of money moving in is just begun, is my belief. 6.7% of allocation of household savings is one of the least in the top 5 economies, if not the least. So I think Mr. Ramdev Agarwal is right in saying financialization could be a liquidity trigger, but there's a big problem, Tanvi, in India. We don't have good businesses listed. The 500th largest stock with free float is just about not even $500 million in a country where there's 826 trillion of household savings. How will we address that without getting into bubbles and speculations and without getting people wrapped on their knuckles is a problem which I think the regulator will need to solve.
Before we go, I just want to quickly get your take on banks because of the deposit crunch that they may face going forward. It's getting competitive in terms of fixed deposit rates and deposit rates for banks to compete with the stratospheric excitement and levels at which the stock markets are trading right now. So it's, bank deposits versus equity investments or debt investments or mutual fund investments, what have you, right? Other asset classes. How do you see that playing out? Because that would be obviously a pressure point for net interest margins. And because there's so much foreign institutional interest in Indian banks, I wonder how you're thinking about that.
You're absolutely right, Tanvi. And it's a very important sector. There is about 18% weightage in Nifty of banks, and financials is another about 7-8%. So this is a very, very important sector to understand where the Nifty is going. So if I have to answer it in a short fashion, so point one, I think the deposit is a problem. Deposit growth is a problem which is going to be not short-lived, going to be long-lived. That's why you would see their valuations are almost about 1 sigma lower than their average P's and price to book over the last 3 years. That's point two. So the valuations have factored that in. Point three, I think that the kind of NIMs are not sustainable. If you look at one of the listed banks, large ones had a 5% NIM. Those are globally the highest NIMs, and 3.84% NIMs are not sustainable. So NIM pressures are going to be there. That's why there's a compression in terms of valuation. Now coming to deposit growth has also impacted, and regulator has done something. The ministry has done something, but that has not helped. So one last card which was there, because debt funds in India were taxed favorably, almost negligible tax, and deposits were taxed at almost the highest rate. So that has been plugged by the ministry over the last 15 months by including an income tax section called 50AA for somebody to actually Google and figure out. In spite of that, deposit growth has not been good. So taxation becoming at par, I thought that the deposit growth will get a great catalyst, but it has not happened. So I think this problem is real and the valuations are speaking, and I think I would not be too bullish on the valuations being cheap. And they're really cheap because they deserve to be cheap.